Welcome to another edition of Inspired Stories, where leaders share their experiences so we can learn from their successes, how they've overcome adversity, and explore current challenges they're facing.
Welcome to another edition of the Inspired Stories podcast, where leaders share their experiences so we can learn from their successes and be inspired by how they've overcome adversity. If you like today's content, please hit the like, share, or subscribe button on your favorite podcast app. My name is Anthony Codispoti, and before I introduce today's guest, I want to say that the information provided in this podcast is for educational and informational purposes only. Nothing discussed should be taken as investment advice. I'm not a licensed investment advisor, and this podcast does not endorse or recommend any specific investment opportunities. Please consult with a professional before making any investment decisions. Now, having said that, today's guest is Chris Seveney. He's the co-founder and CEO of Seveney Investments, a Virginia-based private real estate firm. Chris has been in the real estate industry for more than 25 years, and back in 2016, he began getting involved with something called mortgage note investing. This is where they purchase distressed mortgages and are able to provide their clients great returns with some tax advantages. And we'll discuss how all that works in more detail. He's also a thought leader and member of the Forbes Finance Council, and he has his own podcast that you should definitely check out called Creating Wealth Simplified. Now, before we get into the good stuff, today's episode is brought to you by my company, Add Back Benefits Agency, where we offer very specific and unique employee benefits that are both great for your team and fiscally optimized for your bottom line. One recent client was able to save over $900 per employee per year by implementing one of our proprietary programs. Results vary for each company, and some organizations may not be eligible. To find out if your company qualifies, contact us today at addbackbenefitsagency.com. Now, back to our guest today, the CEO of Seveney Investments. Chris, I appreciate you making the time to share your story today.
Anthony, thanks for having me on, and excited to chat with you today.
Great. So to start off, let me just start with a quick explanation of what I think mortgage note investing is, which is what you specialize in, and then you can fill in any gaps, okay? So you purchase distressed mortgages where people have fallen behind on their payments, and then rather than foreclose and evict, which is seen as a last resort and very stressful for everyone involved, banks prefer to sell these mortgages to someone else at a discount to recoup some of their investment. So your firm, Seveney, buys them at maybe half of market value, which gives you a lot of flexibility to restructure the loans in a way that allows the homeowner to get back on their feet and start making payments again, while also providing good returns for your investors. And I think I saw on your website returns that have averaged between 8 and 11%. And then on top of that, those returns are distributed as dividends, which are taxed at a more favorable rate than ordinary income. How did I do?
Very well. Do you want a job?
Okay.
Can come market, be a sales for us? No.
What did I leave out, or what more is there to the process?
I mean,
there?
You kind of explained it, very well at a high level, because most people never even understood that this opportunity exists out there. And people don't, some things that people should realize about the mortgage market is, it's a $16 trillion industry. So it's probably one of the largest industries in our country. And for those that do own a mortgage, many of us, after we, buy a house, you'll get a letter that says, okay, here, now you need to send your payments to this company. And, most of us seen that where you gotta, now you gotta ACH, mail the check to somebody else. The reason why that happens is your mortgage was sold. Now you don't kind of realize it. You're just like, oh, I'm just going to start sending payments to these people. So the majority of mortgage actually do get sold, whether they're performing or non-performing. So just wanted to kind of, share kind of, again, the size or this market that's out there. And people also ask a lot about like the banks and why do they sell? And banks don't want to own real estate, and they're not in the business to handle this type of product. So it creates opportunities out there for companies like ours to buy this type of debt.
And so are you always buying distressed debt, or is it sometimes just buying, because like what you're describing here is a bank may be the one that sort of initiates that mortgage, but they're not holding on to that note. They're reselling it to somebody else who's then responsible for collecting on it over the life of the loan. Are you also purchasing some mortgages sort of like upfront, like that are still in the healthy state?
Yeah, so we will buy performing loans, which are ones kind of in the healthy state. And the reason we'll do that is, for cash flow purposes. We want a balanced portfolio. We don't want 100% of non-performing loans. For risk and diversification, we'll have a mixed portfolio of anywhere from 60-40, 70-30 kind of mix, and again to blend out the portfolio that keeps them balanced.
And so when you're buying the distressed loans, are you ever buying those directly from the banks, or you're buying them from a secondary holder who purchased them from the banks earlier on when they were performing?
Typically both. Usually, I'd say the majority are from the larger hedge funds, because the way it works typically is a bank may look to sell off $100 million at a time. So a very large pool, which we can't buy. We don't have the capacity right now to buy that much. And they will sell it to, a larger fund. And that larger fund will break it into tranches and say, okay, here's like the A piece, the ones we want to keep. Here are the ones like, yeah, we'll look at these. And then here are the ones we don't want to keep. And the ones they don't want to keep doesn't mean it's a bad asset. It could be in a state they don't like to invest in. It could have a loan value that is lower than they like. Because one thing that's interesting about, the mortgage note space, it costs the same amount of money to manage a balance of $5,000 on a loan or $5 million on a loan. It's the same to foreclose. It's the same to have a company collect the payments. So the size of the loan really doesn't matter. So if you're a larger company, you're typically going to want to hold on to those larger loans so you don't need more manpower to manage them. And some of those other loans, they'll look to sell off. And then that's where we can come in and buy those as well.
And so when you step in and buy loans, are you able to sort of cherry pick the ones that you want, or are they packaged together and it's like it's an all or nothing kind of a thing?
Both. Typically we cherry pick, which is great for us. And I think that's one of the things that, we talk about kind of advantages that we have is an advantage, because those larger players, they're just buying a portfolio. And, basically they have the analytics that say, okay, we're going to hit on this many, we're probably going to lose on this many, and this many will kind of perform as is. Where for us, we get to cherry pick the ones that we're interested in. So, I would anticipate we'd have a much higher success rate because of that.
And what kinds of criteria are you looking for when you're cherry picking? I mean, these are mortgages that are not performing, right? Which is sort of code for people who've stopped making payments.
Yep.
Yeah.
And so we call it the 3 Ps. We look at the person, the property, and the predicament. Now, most people just don't wake up one morning and say, oh, I'm going to stop paying my mortgage. And a lot of these loans that we're buying, they're 12, 18, 24 months behind. It's not like they missed one payment. And when we're going to buy these loans, we get to see a lot of the history of this loan. So we'll look at, of course, the property, confirm what the property exterior condition is, because we can't go knock on the door and look inside their house. But usually the exterior can relay what the interior would look like. We'll also confirm, like, okay, are they paying taxes? Are there other liens on the property? Kind of paint a picture of the property itself and the value. But the thing that we like to focus on is the person and the predicament. And what we mean by that is the person, have they filed bankruptcy? I think my record I've seen is like 7 or 8 times someone's filed bankruptcy. Do they have a criminal history record? What is in those servicing comments about kind of their response or willingness to work with the lender? You see a lot on the news of, especially today, like professional squatters, where, think of there's also professional borrowers. Now, it's very select and few. I think media, of course, blows everything out of proportion. But there are people who, like I said, have filed bankruptcy 8 times. So they are very good at, I'll say, extending the system. And then the predicament component to it, if there's a borrower, it's like, okay, no criminal history, you haven't filed bankruptcy. Then you look at, okay, what caused this issue? And most of the causes are either, unfortunately, they had a death in the family, a divorce, a temporary job loss, or some type of health condition. And typically in most of those situations, we have the ability to work with somebody, especially if it's the job loss, because usually, of course, that's temporary. And during COVID, there was significant losses, and there's always, 3 to 5% unemployment. So those situations, we can see all of the history on what is going on, and then understand, okay, is this something where we can work out a new payment arrangement with this borrower based on buying it at this price that meets our desired returns to give our investors the return we're looking to give them.
And so as you're considering whether to cherry pick a particular mortgage, what you're describing sounds like a pretty time intensive process, right? And how are you collecting all this information? Like some of it can be pulled, from like getting a credit report on the person, but then when you're trying to understand sort of like the personal story behind that, are you able to like interview and like meet with this person?
We can't meet or interview, but there's a third party company in the middle of this called the loan servicer. And they're the ones that actually where the payments get sent. And they're the ones that have all the phone conversations because they have to be licensed. People have probably heard of Dodd-Frank or the Consumer Finance Protection Bureau. Based off of what happened in 2008, which today is very different, government stepped in and put in a lot of regulations and restrictions on debt collecting. So those companies are required to keep very tedious notes. So they have a conversation log, which essentially is like taking this podcast and then putting it into a software that spits out all of the conversation and show notes. Basically they have systems that do that. So they send that to us when we have it under agreement. So we can see every conversation, who it was with, the date it was, what was being discussed. So we can kind of paint the picture from a lot of those comments. Now, the other crazy thing about, technology today is for the cost of about $1 to $1.50, I can go online and basically do a public record search on somebody and see every speeding ticket they've gotten, every bankruptcy they filed, every business they own, every place they've lived, every cell phone number, their parents, their kids, their spouse, their cousins, their nephews. It's crazy what you can find out on the internet. And I don't even need your social. All I need to know is like your name and, one place you've lived or a city you've lived. And I can get pretty much almost anything about you, which is scary in some sense.
Yeah. And I'm curious, the banks or the hedge funds, whoever's holding this distressed asset, if my numbers are correct and you're generally buying this distressed note at, somewhere about half of the value, like why doesn't the original note holder just foreclose and then take and sell that property at market value? It seems like they would take a lot less of a loss in that case.
So with the original lender, which is typically a bank, for people who like to go down rabbit holes, there's a book called The Creature from Jekyll Island. And if people understood our banking system and what's called fractional lending, banks basically create money out of thin air for lending purposes. If you put $100,000 in the bank can lend $1 million to people, and they don't need $1 million behind it. They only need 10% of it. So the banks are in the business to lend, but once it goes in default, that throws their accounting system kind of amok, where now it's considered a liability and it impacts how much they can lend, and they can't create more money out of thin air, and they don't have the team to manage it. So the banks, honestly, if you run the numbers, it's sometimes more profitable for them to just get rid of it and then get a new borrower with an 800 credit score, especially at today's interest rates. For some of these other funds, it really boils down to their strategy, time, effort. Some funds or, other companies, they will not foreclose. They're just like, we don't foreclose. It's not in our business model. So if they think they're going to have to, they're like, let's just sell it. And, and it's a numbers game for them where, again, they've got tens of thousands of assets. And even today, it's rare that you do see foreclosures. For us, we rarely see them because a lot of loans we're buying were originated pre-2017. So think about what's happened in the housing market since 2017. And over time, your mortgage goes down, home prices have appreciated. and people don't have any place to go. Where are they going to go live today? We had a borrower that had a 3-bedroom, 1-bath house in Maryland where they were living. Rent for a 1-bedroom condo was more expensive than their 3-bedroom, 1-bath house. So, they're incentivized to also figure out a way to try and work with us.
And that's interesting that you say that you really don't see a whole lot of foreclosures these days. Is it just that is it like people are coming at this from more of like an altruistic sort of state of mind, like we don't want to put these people on the street, or is it like more of a business decision that it's just so expensive to remove somebody?
It's a mix of both. It's the altruistic of, I think 10 years ago, people caught that wave of foreclose, and borrowers are just handing keys over anyways because they're underwater on these assets. Today, I think society has changed significantly where people are more receptive to working with investors. It's still, some banks still have their hands tied on what they can do from compliance and government regulation, unfortunately. But on the secondary market, we have a lot more flexibility for what we can do because we have investors where banks have, year deposits that they're using. So it's a different animal in that sense. But also the borrowers. The borrowers today are more inclined because they want to keep their property, where 15 years ago, most people had like those 80-20 loans where they had no equity. They're only in the property for a year or two, and they're like, I just don't want to deal with this. Today, people stay longer in their homes. They have, the equity, and they also have that emotional equity where I've been living here. I've had a family here. Like, I don't want to go. I don't want to leave.
No. How are you finding these opportunities? Are this mostly like relationships with hedge funds? Are you combing like bankruptcy proceedings?
Yeah, it's mostly relationships, and typically through people we've bought from in the past. And also there's, companies that are like whole loan traders, which are really M&A companies. So like think of a bank. A bank is not going to have any idea like who buys these things on the secondary market. So a bank will go to a what's called a whole loan trader and say, hey, look, I've got $25 million of loans I want to sell. Can you give me an idea what these would sell for, and then sell them? And these whole loan traders will charge the buyer, not the seller, the fee. So the bank can basically sell them through this company. It doesn't cost them anything. And these companies have all the connections and know everybody who's buying these types of loans. It's similar to like, also when everyone probably heard of Silicon Valley Bank and stuff, like, a lot of their stuff gets sold. Not the bank or another bank that comes in. It's kind of a merger and acquisition company or other types of companies that specialize in this and say, okay, here's who we're putting it out. They also can qualify the people to say, this person's qualified, this person's not, to be able to buy these. And they have all the systems in place to already liquidate these. And since it doesn't cost the bank really a penny to do it, why wouldn't they?
And so are you finding a lot of competition when trying to acquire loans? Are you bidding against other companies?
Yeah, it's very competitive today because there's less product on the market today. But in the same sense, we're roughly a $25 million company. We see on average about $250 million a week in loans come across our desk. So, if we're buying 25 million a year and we're seeing 250 million a week, we're seeing roughly $10 to $12 billion a year. So for us, we still see plenty of product, but in the same sense, our win ratio is, in the teens to 20s because there is a lot of competition. And depending on timing, there's also a lot of money out there that people, are trying to get out the door. Some larger funds have institutional money from like insurance companies and others where their cost of capital is 5%. So when your cost of capital is 5% versus us targeting 8 to 11 for investors, they can be a lot more aggressive on some of that pricing.
What's the trend look like right now? Are you seeing more deals coming in? Is it tapering off? Is it steady?
It's starting to pick up. So we're starting to see uh, more of an uptick. I think, the economy is, very unique in regards to, what people think are going to happen, whether, rates going up, rates going down, cash and getting, investments and where to put some money. Right now, you hear private credit, is the, hot keyword, which is basically kind of exactly what we do, where a lot of companies are getting involved in that. So there's more people coming in. We're also seeing a lot more product, especially on the commercial side. Unless you've been living under a rock the last year, the commercial foreclosures and, office buildings and everything is, there's billions and billions of dollars of debt going into default. We primarily don't play in that space. We primarily play in residential, so there's less competition there. But, typically the residential side, has a lag to the commercial, and we're starting to slowly see that pick up.
What does the opportunity look like for an investor? Minimum investment amount? I don't know what you've already mentioned 8 to 11% for expected return. How quickly do they start to see that?
So this, is something really was unique about our company, and one of the things we wanted to structure was, our minimum investment is only $5,000. So unlike
Very
so
accessible.
it's open to accredited and not accredited investors. We wanted to open up kind of that blue ocean strategy to everybody and give a retail investor an institutional grade product. And your distributions would start if someone would have invested yesterday, which today is May 1st. So if somebody invested in April, they would start accruing their distribution today and get a payment on June 1st. So they start accruing. That's, part of what, having performing loans in the fund as well. So we want to, just, keep the minimums low for investors. We have roughly about 600 investors in the fund right now, to give an idea. So we want to give people that opportunity to invest, and also invest where even accredited investors today, may have $100,000 in savings, but they're accredited, and these offerings out there may have a $50,000 or $100,000 minimum, which they can't diversify. Whereas, we wanted to give people the ability to, because I was an investor, I'm still am an investor, and I invest in other things. But one thing that I've always been taught since I was, this big is you want to diversify. And I learned the hard way when I started out from a company called WorldCom. People probably have heard of them. I was out of college. I'm like, oh, I saved $5,000. Here you go, WorldCom. You're supposed to be the next big thing. And all went down. And even today, we're starting to see people, unfortunately that happened where people in some real estate syndications, took their $50,000 savings, put it in one syndication, and had variable debt on it. And next thing you know, cap rates went up. They've lost everything, and it's extremely unfortunate.
So I invest money today or yesterday, April 30th. I would get my first dividend check in June 1st, so just a month away. And that's actually a check or an ACH direct deposit that's sent out automatically. It doesn't get rolled back into the fund.
Yeah, we don't do what's called a DRIP, a direct reinvestment. My accountant would kill us. We have in-house accounting, and once you start doing the direct reinvestment programs, it just makes it extremely more complex on the accounting side. And if we have limited investors, it's not as big a deal. But when we're growing to get thousands of investors in our offering, and then giving people the option to, the option not to, it increases overhead costs substantially. And for most of the people who look at our type of investment, they are looking for a cash flow play. They can invest other places for equity and get that, equity investment, but we're a cash flow play where somebody wants to basically, pay for their vehicle and they have money sitting in savings. Well, they can invest it with us, get that distribution check, and use that to pay for a car or whatever the case may be.
How would you go about trying to quantify or describe what the risk would be to an investor?
Great question. I'll first start off by saying there's risk in every investment, and that's what an investment is. It is a risk. We try to focus. I like to try and say try to be more boring. I'm getting older and I don't like roller coaster rides. I like, as my wife will say, if we go to a water park, she likes the lazy river. That's kind of what I like too, from an investment standpoint. So for us, some of the things we do to mitigate risk is we don't have debt. So one of the things that I think people need to understand as any part of investment is, where are you in the capital stack? Meaning, when you invest, how many people are in front of you and how much money is in front of you? So I'll just use real estate's a simple example of if you have a $100,000 house and there was $90,000 of a bank loan and you were $10,000 of the other equity, well, that bank gets paid before you. And if house prices drop by $10,000 and it was a rental that's losing money and you're forced to sell, what happens to you? You could lose everything. So that's one thing people should understand is that capital stack, and we don't have any debt. So our investors essentially are in first, whereas if we had to liquidate our portfolio, everything would go to the investors. There's no bank or debt in front of that. But there's also the risk of we're dealing in a space where we're dealing with people who have defaulted on their loans. There's government regulation that could step in, i.e. COVID happened and people, in some states you couldn't foreclose on people. So you were kind of, had a moratorium where you had to sit and wait. Ironically enough, during COVID was probably our best years in my prior offerings because a lot of people were able to refinance at that ultra low rate. So we're getting lots and lots of, payoffs during that time. But, with anything, with risk, it's always going to be inherent that there is risk. It's understanding how is it getting mitigated, and are you comfortable with the people behind the curtain who are looking to mitigate that risk? For example, I've been in real estate for 25 years. If my neighbor wanted to do the same thing I was doing and has never been in real estate, who would you be more comfortable with putting your money with? So understanding the sponsor's experience, how are they compensated as part of the offering? Is their compensation all upfront fees where it's an acquisition fee, a management fee, a yearly fee, and how are the fees calculated? For example, again, on real estate, is it fee calculated based on how much they raised, or is it almost how much they've raised plus the bank debt? Because, the banks has debt. There's a lot involved. For us, I like to think, this is just my personal opinion, that we put the investors first. We don't charge fees. I collect a salary. So I'm just, I'm paid a salary and I don't get any profits of the company until the investors get their money back plus their distributions.
And if I understand correctly, we mentioned this briefly in the intro, the way that you guys have this structured, your investors, their earnings are taxed at capital gains rather than ordinary income.
Yeah, so we structured it, again, I can't provide tax advice, but we're structured as a C corporation. So the company will pay a corporate tax and then investors will get a 1099 dividend, just as if you were investing in Apple, Google, name a public company. We're private. But typically, and this is one thing to understand, part of that risk in your investment, everyone looks at the number of, ooh, I may get this, but that's your gross. What's the net? And, people who, some of our competitors who, a lot of them are very good at what they do, they may structure as an LLC where you get a K1 or a 1099 interest, which unfortunately interest is considered ordinary income, just like if you get interest in your bank. And again, I learned my lesson because in prior funds that I was doing, it would always be the interest. And my wife would always be yelling at me of, hey, we got K1s, which costs a lot more from a tax perspective to have them prepared. Plus, we're just getting whacked with the ordinary income on it as well. And, I'm not complaining that I'm in the high tax bracket, for that perspective. But if there's a way to, uh,
But you're looking for a more efficient
exactly,
approach.
and this is the way we found that efficiency.
That's great. So you've been in the real estate industry for over 25 years. You found this mortgage note investing a little bit more recently. I think you started back in 2016. How did you come upon this? How did you discover this?
Great question. And it's by I call it luck. I joke I either thank or blame my wife depending on how our relationship is that day. And the reason how I got involved in this is I've been in real estate. My wife and I had the dream of building our own primary residence, which we did. And we acted as a general contractor on it because I had that experience. And when we finished in 2013, we timed it perfectly where the market started going up at that time. We had some considerable equity. And at the same time, I was working for a developer who was, I'll say one of my mentors, who was giving me a ration of what, because I really wasn't investing outside of my 401k. And he, coined the term to me. He's like, yeah, you're going to be the 40-40-40 club. And I was like, what's that? He goes, you're going to work for 40 years as a W-2 employee for 40 hours a week, and you're going to collect 40% of the income you're making, and you're never going to be able to retire. And that's what most people, I'm a Gen Xer. That's what we were basically taught is when we graduate college, you go get a good job and you work and you save for your 401k and, you be a loyal corporate employee. And he had owned a lot of real estate in San Diego and other places. And he's like, you got to start buying real estate. You're in real estate. Why aren't you taking advantage of this? So we started buying some rentals and we were fixing them up and, so we were building sweat equity. But after 2 of them with 2 young kids, and plus I had a health scare at the time, my wife's like, okay, we're done. And I definitely at that point in time was getting that taste in my mouth of entrepreneurship. Had a little bit of that taste. So I was like, I got to keep it going. How could I do that in a manner that doesn't take away from my family time? And that's how I stumbled upon note investing as like, wow, you can do this literally as long as you have an internet connection from anywhere in the world. And, so that is how I got into it. And, I started out with, just spent 6 months going down that rabbit hole of learning before I pulled the trigger and, took off from there.
There are obviously a lot of folks, a lot of other companies that are doing what you're doing. We've already mentioned 2 really great differentiators about what you do. One is the low minimum investment, right? $5,000 is pretty accessible for most folks. And the other is the way that you're structured in terms of being structured as a C Corp, which means that your investors are paying less in taxes on those earnings. Is there anything else that you feel, I mean, not that there needs to be, and those are 2 pretty big ones, but is there anything else you feel separates you?
Yeah, and a lot of everybody says this. So, everyone says they're people, of course, is what separates them. But I want to kind of peel the onion back on this a little bit more, because one of the things that I think is different about us compared to everybody else is our integrated approach. Most firms focus on raising the money. And it's like, I got the money in so I can go buy stuff. And they lose track sometimes on the back end of that investor relations side. We differentiate ourselves because, we have our asset management is in-house and our investor relations is handled in-house. So it ensures we have a deep and nuanced understanding of our product and our ability to communicate with our investors. And that I think is so important. I did a webinar last week with one of our investor relations specialists who people were asking questions and she could sit there and answer every single question and know about our offering. And one of the things I read a lot about online, especially today, is people trying to communicate with the investor, and they've either outsourced it to a third party for saving on cost, or they just don't have a strong enough team that can get back to them. And then your investors get frustrated because what's going on? You pause distributions. Why did you do that? How long can before I redeem? What is going on? I haven't seen this type of report. Usually you provide these, so it's, and then when you do get somebody, it's like, oh, I'll get somebody as part of the team to call you back. For us, the person answering the phone, unless it's kind of a technical question about, taxes or, asset valuations or something, from the investor relations standpoint, we have experienced people in-house, and that is something that being integrated, I do truly believe is something that does set us apart.
Chris, I'd like to move into the portion of the show now that in the pre-interview, both of us were excited to kind of dive into, and that's maybe exploring some challenges that you've overcome. And I know that we were both like sort of energized by this topic because, I think, you were saying like in social media, there's, this big sort of misrepresentation of, people who are doing well, like their life is just sunshine and rainbows, and people don't often see like the work and the sweat, the tears, the blood in some cases that goes in, sort of behind the scenes. And I think for other people who are, struggling to achieve a certain level of success, it can be helpful to hear some like, real life examples, some very specific things to sort of use as inspiration in their own lives. What's something that you've gone through that you can share?
One significant challenge that we face in our business has been the competitive nature of fundraising in today's economic environment. We're going against firms, that can promise or, put out there that they potentially could provide exceptionally high returns. And what I believe is at, a higher risk level. And over the past few years, we've noticed a trend where investors have been driven by the allure of those gains because they've been able to have them. And I think people over time have been overlooked some of those inherent risks. And it presents a challenge like us because our priority is, back to what I mentioned earlier, the lazy river approach of slow and boring type of investment. But our response has always been to stay true to our philosophy and what we do. As we mentioned, that Top Gun analogy of never leave your wingman. We don't compete with those types of investments, and we don't try to compete. We focus on our one product. And, it's a struggle because, I've been on calls with investors and they will say, well, I can get 15%. I can get this. I can get that. And, I'm not trying to convince them that I'm going to compete with that or tell them, I'm not going to critique that other offering either because I'm not educated enough or I haven't done due diligence on them. I just need to tell them what we do, and if they get comfortable with what we do and they like who we are, then they'll invest. And there's certain people out there who do chase, high returns and they're okay with it. And, understanding for people listening, who your client is, I think is the most important thing people need to understand is, who are you focused on to be that investor or that client? Who are you trying to sell to? Because if you're just trying to sell to everybody, that's where companies get lost. And then you'll start spending money on paid ads and all this other marketing costs that you're not targeting the right specific person. For us, we like to focus on kind of, that narrow, deep type of individual who understands what we do and is okay with what we provide.
And so has it been hard for you in the past to maybe stay so disciplined and focused on this singular product, this singular avenue? Because, there are other, especially when real estate market's really hot and returns are really high. We've all got a little bit of FOMO in us, right? Like we got this fear of missing out on something else that's going on.
So this is where my business partner is, I'll call her the rock and I'm the squirrel. And one of the things for people out there, when I started my company originally, I tried to do it all. And I was like, I can do it, even if I'm not, maybe I can't do it as good as somebody, but I just tried to do it all. Then when I found my business partner who randomly she found me by a webinar I did on how to lose money in real estate. And she's like, wow, this is the first person who actually talks the truth about, everyone's just talking, here's how you make all this crazy money. This person's talking about how to lose it. So she started helping me with my portfolio, and then realized she had a sales background and she knew how to raise money and she knew the product. But one of the things that she was very good at is, she's a parent, she's a mother, which I think inherently are more disciplined than men. Just, I know my wife is a lot more disciplined than me. It's probably just me, but literally they call me the chief squirrel officer because I have so many ideas, but if I chased every single one of them, our company would be a complete disaster. And you're right. It's like, oh, my background is in multifamily and construction and development. Let's go do a development deal. Let's go buy a multifamily building. Let's go do this. And she'd basically, Chris, narrow, stay focused, focus. And literally, there's a squirrel emoji that they'll send me and stuff like, stop. But yeah, it's very important for anybody who's starting or trying to lead a company. Now, being a visionary is great, and having ideas and vetting these ideas to see, okay, is there ways I can improve my company? But you have to be so careful of just not chasing that FOMO, because people get so sucked into it. And it's literally that rabbit hole that a lot of people just keep falling and realize they got themselves in too deep. And it's extremely challenging to dig yourself out. And, that's where I, again, go back to, the never leave your wingman thing. Just, hey, they're coming around on you, but it's like, I'm not, this is where we need to be, and this is what we should be doing.
It's a common thread I hear with a lot of my friends who are business owners, especially who, they're great idea people. They're in that sort of visionary role. And, right, everything just looks like an opportunity. And where I find that people have sort of been the most successful in their careers is where they have another partner, somebody, on their leadership team that can kind of balance them out. Sort of like, pull the reins back. They even put some rules in place that are like, okay, this seems like a really great idea today. Before you task somebody with it, like, here are the 4 steps that you need to take. You need to sit on it for a week. You need to, write up a 1-page business plan. You need to, let it simmer and let it kind of sit for a minute, and then see if it still seems like a good idea. And then you could maybe move forward.
A funny story with that is, so there's an attorney we've been using for, 6-7 years. And, we always joke because I always come to him with like these crazy ideas, and I'll ask them like, is this legal? Because that's the first thing you always, I like to play by the book. I'm very more conservative. I don't kind of want to have gray across those lines, in sense. So I always run everything by him. Like, is this legal? And, he, probably 9 out of 10, he's like, no, you can't do that, but it's like, he loves it because he's, again, most attorneys are like, they just go through their course of, he's a real estate attorney and he does many different things, but they just go through the bread and butter of like, certain things over and over. And I'll be like, hey, I think like, as part of our SEC offering, can I do this versus that or this? And he's like, man, you make me like think on some of this stuff and, so forth. So he enjoys it actually. Unfortunately, he's like, I'm usually the bearer of bad news, but there are opportunities that, he's come back. He's like, oh no, you could do this, but you got to structure it this way and stuff. And then it's like, okay, then, tell me the rules of the game in the field we're playing on. So then I know how to, create my game plan, use a football analogy of, basically let me know the rules and then I can create my playbook.
Well, that attorney sounds like a terrific partner to have in place because, yeah, whether it's an attorney or oftentimes accountants, like they're very rigid and sort of, like rule-based, and like their job is really to protect you. And so it's a lot easier for them to say no to something just to be on the safe side. But if this guy is, hey, like, okay, that one you can do, but, you just kind of twist it a little bit this way and, make sure that you're compliant. What are some passions or interests you have outside of your company?
Oh man. I love what I do, but really, I mean, my family, is, a passion. I've got a soon to be teenage son. I have a teenage daughter, spending time with my wife as well. And I'm a diehard sports fan. So,
Who are
I'm
your
originally from New
teams?
England, so I'm a diehard Boston sports fan. And one a fun fact about me, I'll say is, and this was kind of like before I even kind of realized like I was kind of an entrepreneur or type of person, is if you don't ask the question, you're never going to find out the answer. So I was on a project. I got a free ticket to the Super Bowl. Is essentially, kind of an interesting fact. And the story behind this was I was building a building for the government, and this was a crazy schedule where we had to design and build a building for the government in 12 months. So never mind, I think it was 36,000 square feet. It was like a $40 million building. But never mind, and everyone who's ever had to deal with the government knows they're not the most expeditious type. So I bet my boss at the time, basically, it's one of those hold my beer type of things. Like, can you do this? I'm like, of course I can. So, and I said, here's the bet. I said, if I finish on time and the Patriots go to the Super Bowl, you're getting me a ticket. And he's like, sure. Okay. Exactly. And this was 2011, 12. When people fall.
So still the Tom Brady years. Yeah.
So we finish on time and they go to the Super Bowl, which is in Indianapolis. So I remember walking to my boss's office that day and said, Mike, remember that bet we made? He goes, which one? I go, about the Super Bowl. He's like, yep. Like, we good? He goes, it's expensive ticket. And, of course, like, don't get it. I wasn't going to get like a box seat or anything like that. And tickets back then actually were like $3,000 to $4,000, which, today it's probably triple. But that was, a unique story of, if you don't ask, you don't tell. Of course, they flipping lost, which was,
Which game was that?
The Giants in Indianapolis, where
that was the perfect season they were working on, and then the crazy. That wasn't the
where I forget which Giants receiver made this. Patriots were leading late in the game. No,
catch on the
it wasn't
head.
That one. That was in 2007, where the receiver down the sideline made the catch. And the series before that, the Patriots were moving down the field, and Wes Welker, I literally was like right in front of. I was up on the upper section looking down at him. He jumped up to catch the ball, and it went right through his hands. And if he would have caught it, would have been a first down. Game would have been over. And he dropped it. Patriots punt, and then Manningham. No, what was the guy? I forget the guy's name. Something ending in Ham. Caught this incredible catch down the sidelines with two guys on him. They go and score and freaking win the game. So.
Oh, right. And Wes Welker, such a reliable receiver.
Yeah, he was.
Have a character for him. That's tough. How about any mentors or books that have been particularly helpful in your trajectory?
So throughout my career, I've been very fortunate to encounter numerous mentors and absorb a wide range of people who've influenced. I think part of that has been being able to work for larger companies on W-2 side, that I've had really great mentors, and I've had interactions with owners who, net worths of $1 billion+ on multiple occasions. So just seeing how those type of people act in meetings, how they respond to people, their professionalism, their charisma, me, seeing that has been kind of a mentor. I mentioned the gentleman who told me about the 40-40-40 rule. Again, another kind of mentor or somebody who really aligned. His name was John. I don't want to say his, full name, but his name was John, and he's I think right about retired now. Or he's probably just doing this as a hobby. Smart, one of the smartest guys I knew, comes from like a family of doctors and just had complete, problem solving, risk mitigation, kind of everything you need from kind of on the real estate development side. So from that standpoint, had a lot of great mentors. In terms of literature, this is actually one I struggle with when people ask this, because there's so many business books that they relate similar themes, such as importance of discipline, focus, perseverance. The core lessons typically that success isn't handed to most of us. There's a lot of hard work that we talk about. It requires the grit and, most importantly, consistency. It's the Mike Tyson quote of, once you get punched in the face, how do you react? The Rocky Balboa quote about getting knocked down, getting back up again. A lot of those principles have been, foundational in shaping my approach to business and life. And, perfect example of, that kind of feeling like you're getting, knocked down is, as part of our offering, we have to go through a financial audit every year, which is due April 30th, which lo and behold was yesterday. And it, to go through, and financial audits they're painful. I mean, in the sense of there's a lot of work involved, and it's not that not that there's issues with it. It's just like the back and forth of the questions and this and that and so forth. And then when you think you're near the finish line, like, oh, now we need information on this or information on that. It feels like you're always climbing uphill in mud, until even yesterday, where we were done and had everything done, they're still asking questions. And we're like, kind of need to hit the submit button here, and, this goes to, as a leader, our accountant literally pulled 2 overnighters last week to try and get this done. And as a leader, understanding that push-pull mentality of sometimes you got to pull people and sometimes you got to push them. And in this instance, it's like, hey, look, you can't push people when they're like this. Like, it's pulling and showing as a leader, hey, I'm going to roll up my sleeves. I'm getting involved. I was like, what do you need help with? She's like, well, we got to get the bills paid because I've been focused on this. Great. Let me pay the bills, and, go in and, roll up the sleeves and pay the bills. Or can you make this phone call? We've got some, updating our benefits because of, the enrollment period, or, whatever is, I think was April 1st or whatever it was. Or it's like, okay, we got to make sure everyone's got that stuff. So as a CEO, it's not you just get to sit back and just tell people what to do. It's you got to lead by example. And by showing people, hey, look, I'm going to roll up my sleeves. I will literally, and my business coach would scream at me like, why are you paying bills? Like, that's, you're getting paid too much. But it's also showing that I'm not afraid and I'm willing to do whatever it takes to succeed. And that is the one thing, as kind of, a CEO or leader with your team, to show you're going to do what it takes, of course, legally,
But you're not just sitting on your couch shouting orders. You're, like you said, you got your sleeves rolled up and you're in the mix with them.
Like literally last night, is a perfect example. We were done, and I had the unfortunately I was watching the Bruins, who lost in overtime. I had that game on, but literally was assisting on some of the things to make sure that as she kind of takes a break today, as she gets up and rolling again. Okay, what can I, here's some of the things to support her to, make sure she, doesn't feel overwhelmed.
Right. Chris, what's something that you wish you could teach the 20-year-old version of yourself? You can kind of go back in time and.
I would say stay inspired. Pursue what you love and seize opportunities with determination. I spent time in my 20s, perhaps like many people, less proactive, couch potato, watching what's on TV. Back then it was the reality shows, Survivor and all those shows. It's like, oh, let me do this. Let me watch this. The internet again. So I graduated college in the late 90s. So, internet was still kind of getting, its thing. You had Blackberries, but you couldn't really search the internet on those. But I was focused on, kind of just whatever, just going through the motions of life and not educating myself and chasing my passion. I think it's a key lesson for people to use your time wisely and strive for personal and professional growth. Now, you need to have fun in life, but for me, I was kind of, you also need to avoid some of those idle activities, and be mindful of things, because you only live once. And that's really where, for me, I had a health scare in 2013 where I woke up one day and my hands and feet were didn't work. They were paralyzed. I couldn't feel my hands or feet. And, basically, I was like, woke up, I'm like, did I sleep the wrong way? You know how you like, I'm a side sleeper. So I'm like, did I sleep on my arm wrong or something and just fell asleep? And then I'm like, wait a second, and I'm waking up. So, um, I realized kind of, they fixed it and so forth. But the light bulb went off at that moment that was, wow, if I was like on disability, I couldn't provide for my family. What could I do? What was there? And then realize also at the same time, my father had just retired at the age of 60 and was very ill. And then realizing, damn, he worked his entire life, never took sick days, took us on vacation and stuff, and was a great father, but was always doing things for other people. And now he's retired where he can do stuff for himself and didn't have the ability to. And unfortunately, he was sick for 7+ years until he passed away at the age of 68. So, and my mother, her dream was to travel to Hawaii. Never been. So they went later on in his life, but I mean, she loved the fact to go, but kind of it hurt her inside because he wasn't able to walk at the time. So they couldn't really enjoy it. And people need to understand, I think, that, tomorrow is not given to, it's not guaranteed. Nothing in life is guaranteed. So make sure you do what you love. And I started the entrepreneurship because also somebody came to me and said, do you love your wife? Like, of course I do, he joked, he goes, oh, not everyone says that. But then he says, and again, I was still working a W-2 while kind of my notes was a side hustle. He goes, do you love your job? I'm like, I like what I do. He's like, well, do you love it? And I'm like, some days, but having a boss, this, and he's like, if you took that reaction and said that about like a significant other, would you recommend that person stay in that relationship? I said, no. He's like, think of your work as a relationship. If you have the ability to, go out on your own and do something, and he's like, just don't quit and not have the financial resources, but plan it out. But just understand that you need to go do what you love. And most people, unfortunately, and again, I was in a C-suite corner office making really good money, not really, I'll say, working my tail off. I was getting my job done, but was I inspired? No. But you fall into this lull of, well, I go to work, I get to leave when I want, visit my kids and so forth. When, don't miss their sports games. I'm making good money. But, you realize that's not what inspires you. And you just get comfortable with things. And what I tell anybody out there is you want to be uncomfortable. Believe it or not, being uncomfortable is fun. It really is. Like, and I tell my team this, like, I said, if you get comfortable, I said, I'm not pushing you hard enough, and again, it's not that I'm going to try and push them off a ledge, but I want that growth. I want you to feel uncomfortable because when you're uncomfortable, you achieve things you never thought you could achieve.
Chris, can we go back to the health scare for a moment? I mean, that sounds like that had to have been a pretty terrifying experience. You wake up one morning, your hands and your feet don't work.
So it was something called transverse myelitis, which is a one-off episode of like multiple sclerosis where my immune system just went haywire and starting attacking my nerves or the nerve endings. And I learned way too much where your nerves are like an electrical conduit where, basically there's a sheathing around your nerves that protects them. But if you damage that sheathing, it impacts that signal. So it was kind of like a one-off episode of that. But my grandmother also had MS. So I'm sitting there thinking, oh, shoot, is that what I have? And then being in real estate and construction, like, I never saw her walk. And I'm like, well, I can't walk. Like, how can I go walk, go visit a job site? So scared the heck out of me. And, come to find out years later, it was really spurred by a second health scare I had 5 years later, where I was having some pain, some hip pain. They just go do an ultrasound and they mentioned like, something, your liver doesn't look right. Your liver lit up. And come to find out, I have something called hemochromatosis, which probably nobody's ever heard of. It's called the Irish something, or the Celtic curse is what it's called. And what it is it's the opposite of anemia. So most people who are anemic have iron deficiency. I have the exact opposite. My body doesn't get rid of iron. So my liver was storing all this extra iron, which my body was probably what caused the issue 5 years ago of basically got too overloaded and basically started just attacking things. Thankfully today, the great thing about it is there's no medication you need for it. The way you get rid of iron is you donate blood. So I donate blood every few months, and that basically kind of which actually reading about it, everybody should donate blood, by the way, because think of a car and an engine, you change the oil, with your, think of your heart is that engine, the blood is that oil where, donating blood starts to create new red blood cells and everything and kind of filters everything out. So that's how I get rid of iron is I go donate blood.
How did you deal with the issue initially, though? It wasn't until 5 years later that you found out that the buildup of iron was the cause. How did you make that initial recovery?
So I spent about 2 weeks in the hospital. I was on steroids, on anti-inflammatories, went through 2 spinal taps to figure out like what was going on. And during this whole time, it was so scary because it was also the time when a lot of like the ALS was in the news. And so I'm thinking, in the internet's your worst enemy because you're just Googling like, what could I have? What could it be? And all of these are what's called differential diagnoses, which it's not like a blood test that says, oh, you have this. It's kind of like they evaluate everything. So I spent 2+ weeks in the 1 to 2 weeks in the hospital going through tests every single day. But thankfully, the steroids and the anti-inflammatories and some of the other stuff they gave me basically calmed down my immune system. So I didn't have any true permanent nerve damage. Certain things, I'll say, I do have some muscle fatigue, kind of like people who have carpal tunnel, essentially but for those 2 weeks, it was just a roller coaster ride of like what is going on. Not knowing is the worst thing of like the test, and we're not sure. We're not, as the steroids kept kicking in, levels kept going down and down. Took about a day for me to start getting. It was interesting because it almost was like a body part falls asleep where it's numb. Then you start feeling pins and needles. So I started getting some sensation back, and after a few days, I had it back, but I had significant like fatigue or weakness to the point of like, okay, I had to learn how to like open my hand and close my hand again. Just how to write, and just rebuild that muscle memory. Cause at first like, okay, it was, I could write, but it was like, my hand, I would just get tired. Like, so thankfully kind of, did a little bit of rehab and stuff and went through all of that and, overcame it. And, they basically after about a week, they were trying to figure it out, but they, everything started getting better. So they were kind of the opinion, okay, you're kind of, on the right path. They didn't think there'd be future flare-ups from that. So kind of started to settle down a little bit at that point in time.
Wow. Well, thank you for sharing that. That sounds like it would have been a really scary time. Chris, I've got just one more question for you, but before I ask it, I want to do 2 things. The first, tell our listeners, if you like today's content, please hit the like, share, or subscribe button on your favorite podcast app. The second is to point people to the best place to contact you. How should people get in touch with you? They can
go to our website, 7einvestments.com, and that's the number 7, the letter E, investments.com, which you can put in the show notes, or they can email me, chris@7einvestments.com.
Terrific. So last question, Chris. How do you see the industry that you're involved with evolving in the next 5 years? What do you think the biggest changes coming are?
So I see the biggest change in our industry to see continued legislation to protect homeowners that are in default, which, it's really state dependent, which is a very unique situation. So we have to know state laws in every different state. And we've already started to see it, especially in bankruptcies, where courts have gotten more creative, I guess, is in the way to work with borrowers in bankruptcies to try and keep their homes. So I think, legislation is going to continue to move forward in that direction. So companies that are similar to ours that really more have that foreclosure mindset on things are probably going to have it a little harder because it's going to continue to lean towards being everybody's best interest, try and keep people in their homes, especially as interest rates remain high, which I don't foresee them going back down to the 2-3% like they were. Most people can agree that we could use more housing in this country as well. So there's the housing shortage. So when you look at everything that's going on, we're going to continue what we believe to see more and more leaning towards the ability for people and options out there to work with borrowers. And some things we've already started to see is certain states actually give out additional funds as part of programs that, again, some were from COVID, but a lot of states have always had these programs for like zero interest loans to borrowers to try and bring them current on their properties. So I think we're going to see more, more towards that.
Chris, thanks so much for sharing your story with me today. I really appreciate
Anthony, thanks for having me.
That's a wrap on another episode of the Inspired Stories podcast. Thanks for learning with us today.